This Pitch Breakfast video is brought to you by Spangler and Agins, attorneys for Charlotte's startup community.
By show of hands, how many of you would like to save money or your loans or mortgage? Anyone? Okay, I see hands everywhere. So I'm sure we can use that extra money for something like Starbucks or shopping, right? I mean, we could all use extra money. But the answer that my question is you save money by balancing the steady payments you receive on fixed rates with the upfront costs and variable rates. And not only is saving money important to you, but it's important to companies and investors as well. I'm Chris Rivers, founder and CEO of Optimis, and we help companies and investors manage their bond investments by offering proprietary interest rate products and analytics. Right now, I realize as an investment banker and later a bond investor, although companies raise trillions of dollars each year from investors, both of these parties have competing interests. Companies want to lower their borrowing costs and minimize their payment fluctuations, while investors want higher returns and risk protection. So because of this, both of these companies and investors, they end up going to a third party to manage that risk. And that third party effectively says, hey, I'll provide you a payout in certain situations to kind of help you manage your risk. The problem with that is you have risk management and capital raising in two different steps. That's inefficient. On top of that, the third party is risky because they may not be able to provide those payouts to those both parties, which means that's more risk. Not only that, companies and investors spend $30 billion a year to protect nearly $15 trillion in debt. On top of that, in that arrangement, those companies and investors may also be on the hook to pay the third party in certain situations. So this all adds cost, risk, and complexity to the bond markets. Optimis has found a smarter, cheaper, and better solution for managing this solution and risk for both of these parties. We're empowering the company. They can go to our marketplace and buy a proprietary interest rate product that controls their investment. Basically what happens is when they buy our product, they can determine how much of their payments stay the same or fluctuate. They can also lower their borrowing costs because of this. On the flip side of that, investors are able to receive a stable return because of this arrangement that also increases when market rates are increasing. We're also going to provide an analytical solution to investors in this particular type of transaction. We're providing them an understanding of the risk and return of their portfolio. We're also going to provide them analytics to help them understand to enhance their portfolio strategies. We take a 45 basis point fee, or in other words, 0.45% fee on every interest rate product that's purchased. Each year, about 3,000 transactions happen in the market. We're targeting just 45 in 3 years. Assuming an average amount per transaction, we're equating to about $122 million in 3.5 years. Through strategic partnerships with banks and financial institutions, we'll promote and distribute our products on the product side as well as on the analytics side. In the green, you see our focus on the U.S. market. Our competitors provide risk management and analytics to address but not solve the core problem. The core problem is the bond is broken. A bond is not should. So the investor takes the hit. And on top of that, a bond does not help the company manage the payments. Because if the payments are really high and it does not change with them, meaning if the company is doing better off, they should also pay less. But it doesn't do that. It's inflexible. So our product basically addresses a core issue. The other competitors does not. My background is in mortgage banking, investment banking, as well as bond investing. My co-founder and CTO, Cedric Tucker, has 24 years of experience as an IT veteran. He has nearly a decade of managing technical staff, as well as supporting trading applications. We launched an MVP back in March and working to leverage pilot programs. And through strategic partnerships and partnerships with banks, we'll launch our product in August. We're looking for connections at banks as well as those. And lastly but not least, we'd like to meet you if you're in the bond markets or capital markets or risk management. Thank you.
I can start. Hey, whoa. Is this okay? Too loud, too soft? Everyone cool? So, couple of things. So I'm an active investor, sophisticated, like I'm managing money every day.
Awesome.
I'm still not sure what you guys are doing, so that's a problem. So just recommendation, 3 minutes in, you kind of said the core problem is bonds are broken, which actually kind of was an interesting hook. So I might actually start the pitch more with that fundamental opening statement. Your problem was abstracted in a way on slide 2 that if I can't get it, like, I mean, 99.9% of the people that you're probably trying to pitch in a 5 to 7 minute format aren't going to get. They might, but I don't think they will. So bonds are broken. Then just get 2 or 3 core points, talking points as to what that means, and then go to the solution in a much tighter way. It just took you too long to kind of get to that. So that would just be the, how to re-architect maybe the pitch.
Sure.
And then one more comment. When you talk about an MVP, the thing I always like to see is like, hey, we have this minimum viable product out. Here's what we're testing. Here's the 1 or 2 things we're trying to figure out. It might be customer adoption. It might be the efficacy of the tech. But just follow that up, because a lot of times I think that MVP term has become so overused, and it just to have an entrepreneur kind of explain to me why they're putting something out there and they've spent their own personal time and capital doing it. It just allows us to connect a lot quicker on, okay, cool, like, so I know what you're shooting for, not just like, hey, I've got an MVP out because I'm an entrepreneur and we've got a developer and we're coding and all that stuff. So just be kind of 2 points. Yeah.
Great job. Polished. I mean, I think you're very comfortable in front of a group, and that's good. It's hard to stand up in front of so many people and give a pitch. Agree with these prior points. A couple things. I liked how you addressed the competition. I think that's important. And I think that ultimately, your space that you're playing in, where you're doing things differently. What I would like to see is when you're along the lines of the MVP. What has been your initial feedback from your customers? So your customer is not in this group, which is how you open your pitch. And I think that if you just talk through the problem quicker, really trying to figure out, okay, it's not the consumer, it's not me, it's these companies, management. Why did you start it? Ultimately, what has been their initial feedback? I think, again, from investors, they want to hear the traction you're getting. So it's like, what are you trying to prove? But ultimately, selling. What's the feedback? And on the slide where you were saying size of market, it's a fairly large market, and you're saying you need to go get 45. Okay, why 45? Are they hard to get the 45 deals? The 45 deals are translating into a decent size pie to start with, but I was like, why 45 and why 45 basis points? Or sorry, it was 45 basis points and then 45 company transactions.
Right.
So that was just a little bit more context there would be helpful if you're really trying to get the investors. And then how does that scale over time? Again, your early stage things are going to get in the market to start playing. But that was just the 45 basis points versus what are they paying, with these other competitors. And then proprietary. That term, just like MVP, is thrown out there a lot. Okay, why is it proprietary? How did it take you time to develop it? Is it scalable? That's my initial feedback.
Sure.
Chris, I like the delivery. I love the fact that you actually hit the time limit because very few people usually
That's good. Yeah.
appreciate that.
Good point.
And I actually started my career down the street decades ago. I won't say how many. But my job was actually doing the interest rate forecast for one of the banks down the street. So interest rate risk is something I'm pretty intimately familiar with. On your problem definition, as Mark was saying, you need to get that. It took me a little while, and I it took me a little while to figure out what your tool was, right? So your about interest rate risk, right, and how to manage that. So I think that needs to be said sooner to make sure you get, folks that may not be familiar with that marketplace. The other thing that you did that I liked, team slide, and again, obviously with your background at TIA, I would have done probably a little more about that, right? The reason that you're here, the reason that you're actually seeing this is you were living that problem because TIA has got a large bond portfolio and a lot of interest rate risk to manage, right? In terms of the competition, one of the issues if you're really creating a marketplace, right? Back when all the digitized, right? When a lot of those companies that you mentioned were moving from basically all bond trading over the phone to digital, that happened 20 years ago, right? So if you're doing a marketplace now, how is it different from those, and what are the unique things? And I think one last thing in terms of market strategy was, who is actually your target customer then? Is it really the banks selling the bond, companies that are buying them, or is it both? And I think the answer is both, but I think that needed to be articulated a little better. But overall, great job. Definitely an interesting marketplace. And I might have spent a little bit more time on size of market. Right? Bond market, absolutely enormous, and what piece of it are you going to peel off?
Thank you for
Yeah,
feedback.
one more question. So is the core customer, like say I'm an active manager of liquid investment grade debt in New York City, right? I have $1 billion under management. Are you selling this to me as an active manager of, like, I'm buying bonds in the market every day and selling bonds, or is that, who's the core, who's the target?
It's a two-sided market, so clients are companies who are selling those investment grade securities to you.
Yep.
Investment grade meaning higher grade, higher quality bonds. And then if you're an active bond manager, or you want to you actively manage your interest rate risk, you would also be interested in this type of investment.
Got it. So issuers and active investors in liquid. Right. Okay. And it's the liquid markets you're going to focus on versus more the illiquid.
Right. Start with the mature conservative markets first,
Yeah.
and then trickle your way into other markets and asset classes.
Okay.
So follow up on that. Also, is what is the value of that customer? And so
What's the
the
value?
value of the customer. So are you trying to go after, this is your target, and all of these customers are worth X, or are you trying to hit two pieces, and there are two different sides of the market, and this one's a bigger player and is worth this, and this one's a smaller player and worth this. Again, I think if you're trying to go, if you're wanting to get investments, you want to just peel out that segment in terms of who your customers and what the worth is. And then I don't know if if you have a runway and a ramp, but where do you need to have, where are you estimating needed tranches of cash, or where do you become cash flow positive would be helpful.
Okay, I've got one last thing. So I'm an economist at my core, so there's something called Say's Law. Have you heard of that? It's, supply creates its own demand, and it's the short version. For any marketplace, right, when you've got buyers and sellers, you have to figure out a way to get buyers and sellers into a marketplace, and the only way you're ever going to do that is to actually have supply. So that tells you where you need to go first.
Awesome. Anything else? Thank you for your feedback. Thank you.
Well, no, we've got time. Audience? Anybody got
CC
questions?
Lewis, and I see.
Yeah, go ahead.
Sure. Does your app see more profits in an unstable environment where you see higher interest rates, or does it make more money when there are lower interest rates and the economy is sound, or does it matter?
So the product itself is a bond or a debt security that adjusts its cash flows depending on where rates are moving. So once the bond is sold to investors, investors have it in their portfolio, the value of that may fluctuate depending on where rates are moving. So when you think about from a management perspective, how does that impact the performance of my portfolio is more of the angle you want to have.
Does that answer your question?
Well, like, when's your company the most profitable? Like, what environment?
So our business model is the company will buy the product and sell that product to investors. We make a transaction fee off that initial transaction, and then we manage their portfolio of debt, the company, over time. So our profitability is a transaction fee off the initial bond raising process, and then we manage their corporate debt over time. for the life of that investment. Steve Lewis.
Chris, I've sat on an institutional sales desk selling bonds for the majority of my career, and this is innovative. This is disruptive. Primarily because you're taking out counterparty risk, and then you're creating a tool that issuing companies need. How are you going to get to those issuing companies, and what is your strategy there?
So it's really three-pronged. So part of our commercialization strategy is to make sure our IP is together. If we have IP, then our marketing is a lot more expressive. So we would talk to companies, we would talk to banks who know companies, and we talk to financial institutions who invest in companies, and align those interests there, creating a market from three different angles.
All right, thank you, Chris.